So, what is the actual number that preserves capital in perpetuity over the last 20 years?
So what I did was created a spreadsheet that talks about a few different concepts associated with FIRE, financial independence, retire early, and explain those with a little bit more math, and it seems a little more concrete to me. I almost always follow things better whenever it's in a spreadsheet. So I started by talking about a few concepts such as safe withdrawal rate, which you'll hear me say a few times, maybe just like withdrawal rate, which is the concept of how much you can take out of your portfolio every year and you can safely withdraw that and you'll never theoretically run out of money. So I did a little bit of analysis on the safe withdrawal rate and I did some scenario analyses on how your theoretical or proposed withdrawal rate will affect how much you actually need to save, how much nest egg you need to build up in order to actually meet the spending requirements that you have for yourself or that you want in the future.
So I'm going to jump right in and start going over all the calculations that I did as a result of this sheet. So what I did was do a few different scenario analyses. The first one is how much nest egg do I need? The second one is how much can I afford? And then I did an actual scenario analysis over here that showed us what net worths combined with what withdrawal rates would actually work for us. So in the first one, how much nest egg do I need? I lined out a few different monthly expenses: food, housing, auto, insurance, etc. You could always add to these if you like. And then I multiplied them by 12. I set my withdrawal rate, and then I divided the yearly out by the withdrawal rate in order to get the nest egg needed at this withdrawal rate to get this much out per year. As it turns out, my expenses that I made up came out to about $219,000 per year. With a 3% withdrawal rate, that's $7.3 million. So if you wanted to have expenses similar to these, you would need $7.3 million. Or put a different way, in order to reach your desired level of retirement, this is the amount you would need. This is the amount of nest egg that you would need, and you would need to withdraw it at around 3% per year. Or, put even differently, your expenses could be $219,000 per year, each year ongoing until you kind of ran out of money. You may not ever run out of money. We'll actually analyze that in just a minute. So if you want to do it a different way, how much can I afford, wherein you put your current net worth down. This is how much money you have in theory, and you want to withdraw it at what rate, which we put 3% in, and you want to allocate what percent of that income to different expenses, then this is what you wind up getting out. So if you have $8 million and you withdraw it at a 3% rate, and you allocate 20% of that to housing, you can afford a monthly payment of around $4,000 plus or minus. So let's look at that a little different way. We have our desired annual spend over here of $219,000, and I've just pulled that from our first calculations. What scenarios work for us? So I did a little bit of conditional formatting and made it really easy to see visually which scenarios work for us. Where in the green are numbers greater than this 219,000, and the red are numbers less than 219,000. So if we look down at the greens in the $5 million column, we can see that if we withdrew money at around a 5% rate, we would be greater than our desired annual spend, and this number could work for us. Now, whether the market could sustain a 5% withdrawal rate over the rest of your lifetime, that's yet to be seen. We have no idea how to predict the market. You can look at a few different scenarios. Obviously, if you have $25 million, it's fairly easy to hit that number, even at a 1% withdrawal rate. Okay, so I want to look at this in a little bit different format on the next tab, in that the traditional ideology is, a 3 to 4% withdrawal rate is safe. And I don't necessarily want to argue that, but what I want to show is that fluctuations in the market, especially large fluctuations in the market, can have a little bit more effect than I think is realized. So what I did was I went back to the year 2000 and I started with $2 million and I accounted for inflation and got all of the historical return rates of the S&P 500. If we put in a 3% withdrawal rate, we can see where we get. So we can follow this along for a little while and say that at 3%, we started with $2 million, and that means that we're going to be spending $60,000 a year, or our desired spending in perpetuity is at least $60,000 per year in today's dollars. Whenever you account for inflation down the road, it obviously rises significantly. So I got historical inflation as well and added that in for the previous year. So 3.4% of inflation for 2001 was had in 2000 because our spending begins January of 2001. The inflation for 2001 isn't particularly relevant. It's more from the last year. That is how I did this analysis, and I wanted to show you the ups and downs that can be associated with it, especially since the year 2000. We have a few bear markets, a few bull markets, a few really bull markets, and then of course we had the 2008 recession that shows, how it's more of a cash flow calculation than just I can take X amount out per year. So I want to actually go and show you down here the real rate of return over the last 20 years, accounting for inflation. It's around 4.9%. So what is the actual number that preserves capital in perpetuity over the last 20 years? So what is the actual number that preserves capital in perpetuity over the last 20 years? Down the ending value row until we get to a negative number, it'll last us 14 years. I would say that's not what we're all shooting for here. That's because as we go down and have these bear markets like 2000, 2001, 2002, the percentage that we're withdrawing goes up as a result of the total nest egg because we're compounding our withdrawals through a bear market. Put a different way is, if we look down here at 2002, our withdrawal amount, $104,000. We got it from right here. The beginning value was 1.375 million. So our actual withdrawal rate was 7.6%. That's a huge problem that compounds, and it takes us even longer to work back up to the original amount. Now, this is the other thing I see wrong with a lot of, you can take out 3 or 4% per year. The problem with that is, if the market goes down, are we supposed to adjust our spending to meet your net worth? I don't think that's the way that you plan for retirement. You want to have consistent spending across your entire retirement, not necessarily adjust up or down as a result of the markets. It's a little stressful. I set a withdrawal rate at the beginning, accounting for inflation for the rest of eternity, or 20 years, and we came up with a number. So what is the actual number that preserves capital in perpetuity over the last 20 years? Well, it actually turns out to be 2.625%. So if we put that in here, then we can go to the current year and we're almost bang on $2 million, which is what we're looking for in my mind. That means that we are able to retire with 100% peace of mind forever, essentially. Now, this number could be adjusted up and down, of course, based on your age and your expected livelihood or expected lifespan. This can go up or down. If your expected lifespan was 30 years, then you don't necessarily need $2 million in 20 years. So you could bump that up a little bit. Of course, you can't bump it up as much as you may think because of the fluctuations in the market and the compounding withdrawal effects in a negative market. Once again, if the market returns negative 13% and you take off an additional 3 or 4% on top of that, you lost 17%. So it's an essential way to look at this and an essential way to plan for retirement. I like to think about things up, down, backwards, forwards, every which way. And I want to go ahead and say that I don't necessarily disagree
with a lot of the assumptions that are made in that 3 to 4% safe withdrawal rate. If we continue to see markets like we've seen over the past 10 or so years, then you gain enough over these time periods to where even if you're over withdrawing during some of the bear markets, it's really not that big of a deal. I also like to be really safe. So I am really erring on the side of caution with what I calculated as the safe withdrawal rate into perpetuity. Also, it bears saying that the lower that safe withdrawal rate goes down, the longer it's going to take you before you can retire, because your nest egg has to be larger in order to compensate for the smaller safe withdrawal rate. So that's all I have to say. I hope you learned something. I hope it was informative. And if you have any ideas for future topics you'd like for me to cover in a similar niche, I'd love to do it. I really like doing these things. So thanks for watching. Peace.